Hello. It's 4:21 p.m. So good afternoon. My name is Angel. Most of you guys obviously know me. I'll be teaching you how to trade. Okay, nice and simple. Before I have to give you a warning. Okay, this shit is not easy. So if you think this is gonna make you money super fast, super quick, get the fuck out of here. I'm not gonna waste my time. If you're a quitter, get the fuck out of here. I'm not gonna waste my time. If you're a bullshitter, get the fuck out of here. I'm not gonna waste my time. If you like to fuck around and not take shit serious, I do not want to waste my time. So get out of here. Take this shit serious. I'm expecting you understand that you need to take this serious. And I'm expecting you put in effort, you desire that will get you farther than you can ever imagine. What I mean is, only you know your true potential. Only you know how far you can truly get. And only you understand what you have to do to get there. Right? So, an example, I knew where I needed to go. I knew what I needed to do. I knew where I needed to get done in order to get where I wanted to be. Right? There was a point in time where I literally had 8 hours of sleep for a whole week. Not just one day, a whole week. If you're not able to take any sacrifices of those sorts, this is not for you. The more you want this, the harder it will be, but the easier it'll be. Give it time, put in effort, stay disciplined, give it some dedication, and it'll pay off the rest of your life. Without those things, you won't get far. And in all honesty, 99% of traders lose money every single day. So if you were to quit, I wouldn't be surprised, right? Here's an example, right? A lot of traders quit because they lose money. A lot more quit because they think it's too hard. A lot more quit because they think it takes too much time. Even a lot more quit because they get lazy, right? But only those who stick with it, only those that truly end up understanding it, that put in the effort, the time, the dedication, only those with true dedication see the top. So you decide whether you want to see the top or you want to stay at the bottom. You choose. It's your life, not mine. I already made my decision. You got to make yours. So I'm going to teach you guys how to trade, right? So right here, I'm going to teach you guys Forex to start off, okay? Essentially, with this method, you can trade everything, okay? So I'm going to explain Forex because Forex is a good thing to start off. It's pretty good volatility, decent enough, stable wise. It's not crazy, right? Crypto's kind of end game. Oil is oil something, and then you have gold, and then you have indices. Indices are really good too. Gold, indices, and Forex are where good money's made. Crypto is where good money is kind of grown, if that makes any sense. But your real money is grown in gold. All right. Um, Obviously, it's a preference depending on what you want to do. Right. For me, I like indices and Forex and gold. To be honest, I trade everything. So to me, it doesn't really matter what the fuck I'm trading. Just matters how much I'm able to, you know. So in the market, there's two things: you either liquidating or liquidated, right? So in instance, or sorry, in an example, that would be either you're making money or you're losing money. There's no in between. You're either doing one or the other. Okay, so I'll be going all the terms you guys are gonna need, right? So forex market is always quoted in pairs. Okay, what is a pair? Literally just two different currencies. Okay, so price of pairs is how much it costs to buy 1 unit of the base currency. For forex is always buying 1 unit of one currency while selling the other. So an example would be Great British Pound versus U.S. dollar, right? This total value of this pair would be $1.32, right? So we have quote currency, base currency. How much would you need to buy this pair? you would need $1.32 in order to buy Great British pound. So the pip is the fourth decimal point. An example would be we have $1.12 right here with 98 pips. Why? Because 1, 2, right? After these two, right? So this is the ones, this is the tens. I guess if you want to be smart about it, hundreds, right? So we'd have $1.12 with 98 pips. Okay. So the 8 in this the 8 is the fourth decimal. So if it goes up 1 pip from here, the price would be $1.12 with 99 pips. Okay. So there's things called lots. There's things called, the names of the lots. And there's the amounts of money you can make or lose per pip. Okay. And this is the amount it would cost you, right? So let's go over the differences. So we have a 0.01 lot, which in instance would be called a micro lot, which each pip up or down would get you 10 cents. Nice. Okay. So the total amount of currency you would need would be 1,000 of the currency in order to afford a micro lot. In this example, we have Euro USD and current price of $1.13 with 6 pips. An example on how much money you would need based off this example would be $1,130 in order to afford a micro lot. Nice. 0.10 lot. Okay. This thing would be called a mini lot. Nice. So each pip up or down gets you $1 or loses you $1. In this example, you would need 10,000 of the currency in order to afford a mini lot. So right here is $11,306 is what you would need to be able to afford a mini lot. Okay, based off this price right here. Okay, then we have 1.00, which is a standard lot. In this instance, each pip up or down gets you $10. Nice, right? So total amount of money you would need is 100,000 of the currency, right? So in this instance, with this current price, you would need $113,068 in order to afford a standard lot. Nice. So now we know how much we need in order to afford each different lots, right? And how much we make or lose per pip. Nice. So we're going to move on. Okay. So teach you guys how to read the market and how it moves based off previous action or what's most likely to happen. So we have where price has been. This right here is called a wick, right? So let me type this out for you guys. Wick. Nothing crazy, just wick, right? Maybe wick has a H. I don't. Point is, this right here, the yellow, is called a wick. Okay, so we have wick. We have the body. We have the open and the close. Wick, body, open and the close. Why is the open here and why is the open here and why is the close here and why is the close here? Well, it's because one is bearish, one is bullish. Bearish because bears charge downwards. Bullish because bulls charge upwards, right? So they go two different directions, right? So bearish means, oh shit, we're losing money. Bullish means, or we're making money. Depends. Later on, I'll show you guys. Bullish means, nice, price is going upwards. Bearish, damn, price is going down. Okay, now that we understand how candles work, we can move on. So let me go over it just in case. This is a bearish candle, meaning we start from top, we go to the bottom. Price, let me do an example here. Price opened here. This is how a candle looks, right? So it does this weird Yankee shit until it decides it's enough, and then it stops. Okay? So an example would be price eventually went up here, went down here, ended up closing here. Nice. There you have it. The wicks represent where it's been. Candle, body. This is where it finished. So, same thing here. This one opened here, this one closed here. This one, next one opens on the close. So next one would open right here. Boom. The same thing. There we go. So now we understand how candles work and why some are different colors. Okay. So now let's go over this. So we have something called liquidity, which is, in instance, orders that haven't quite been filled or that are wanting to be filled. So people want to buy at a cheap price and sell at a really good price, right? So people want to make money and people want to save money. Okay. So what do? People literally buy when price is low. People literally sell when price is high. Boom. Perfect. Now we understand liquidity, right? So the market's always chasing liquidity, right? Because the market is greedy. The market wants money. So it's always going to want to fill orders in order to collect more money. So we have right here bearish candles, bullish candles, bearish candles. How do we know what happened? Here, let me explain something real quick before we keep going. So there's things called trends, okay? So we have boom, 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 boom. Look at that. It's going up, ironically. Uptrend. Nice. Okay, we have something called boom, 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 boom. Something price will never do is go backwards. I know it sounds crazy, but generally, this is what price will never do. So something like this would be considered consolidation. Staying in a box, in an imaginary box. It's going sideways. It's not going up or it's not going down. It's just going sideways. I wish I drew it smaller, but it's fine. So we have uptrend, consolidation. Then we have downtrend. Boom, 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 boom. Right? Uptrend, consolidation. Let me spell that out for some of you guys. Consolidation. Consolidation. So we have consolidation. Boom. Uptrend. And downtrend. Nice. Uptrend, downtrend, consolidation. Only trends. Okay. We have something called what are they called? Shoot. These things right here. Boom. Essentially price always goes back, right? So it always retraces. That's what it's called. A retracement. Retracement. Oh god. Retrace. There we go. Retracement. What? Oh shit. There we go. Retracement. Okay, so we have something called retracement. So what is retracement? So essentially, price goes up, boom, retraces down, boom, retracement. Goes up, retraces down, boom, retracement. Up, retraces down, boom, retracement. Same thing, downwards. Down, traces up, boom. Down, traces up, boom. Down, traces up. Simple. Nice. Even in consolidation, it happens. Up, retrace, up, retrace, up, retrace, up, retrace, up, retrace. Same thing, right? So we have these four things, right? Retracement, downtrend, consolidation, and uptrends. Okay. So we have this. And this is called break of structure. How to identify, essentially, there's a thing called order flow. Order flow is just a fancy way of saying uptrend, downtrend, consolidation. So we have bearish order flow, right? How do we know when the order flow is going to change? How the trend is going to change? We have a break of structure right here. What is a break of structure? Break of structure is when a candle body closes past the previous wick. In this instance, this body closes above the wick. That's why I drew a line here, so you could identify it, so you could see it clearly. And that's why I highlighted them, these two candles, so you could visibly see that these two candles have an important part playing on a change of trend. So this one, the top, closes past the previous wick. What does that signify? The next candle is most likely going to be bullish, right? And if it keeps continuing, it's going to keep continuing until it decides to do the same thing, just on the opposite side of the spectrum. Boom. Closes past, or sorry, below this wick, right? So what do we have? We have disrespect of trend, right? Downtrend, okay? And then we're going to go down. So the thing is, right, this happens. It's normal. Like I said, retracements happen. But the thing is, right here, we'd go from boom, 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 boom. That's how an uptrend would look. But, right, how to really identify a break a trend. We have lows here. If the next candle closes past this one, we're 100% going down. I don't know how far, right? We can identify later, but we'd go down. But in this instance, we're going to continue going down until it decides to do the same thing on the opposite side. So this could be a simple retracement and then we go back up, or this could be the start of a disrespect on the order flow, meaning we're gonna continue going down. So that's why it's important to keep an eye, right? Depending on what you're doing. Okay. So we have break structure here, uptrend, break structure, downtrend. Okay. Boom, boom, boom. Nice. Liquidity up here, right? Orders want to get filled here. Orders want to get filled here. They're always above and below of the actual price action. Price action is how the market's moving. So the candles, if the candles are moving nice and quick and juicy and whatever, nice. You have really good price action. You have good volatility in the market today. But if they're really fucking slow, that shit price action probably shouldn't even be trading because there's zero volatility. It's not going to do what you want it to do. It's going to take a long ass time to trade. It's not worth it. Okay. So we move on. There's a thing called liquidity sweeps, right? So we spoke about liquidities. We spoke about where the orders are, right? So we have a previous high and a previous low, right? So that's always in the market. Boom, 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 boom. So on and so on and so on. So we have this right here. Boom, previous high, previous low, lower high, higher low. What happens here? This one probably closes above this one, signifying we're still gonna go up, right? Boom. Okay. So the thing is, right now you can see we're in an uptrend, right? So that's how to identify what is really going on, right? You go previous highs, previous lows, keeps going until it gets disrespected. How does that get disrespected? Candle closes past previous lows. Boom. Gonna start going downwards. But wait, what happens? Boom, boom. Goes back into this old trend, or it's gonna eventually go back into it. But for now, we're gonna continue going up until it decides to drop under here. Then we go lower, or it breaks up past this right here, and we continue going higher, right? So that right there is how you identify previous highs, previous lows. They are always there in the market. You'll see the peaks, you'll see the lows, and you'll see this happen all the time. So liquidity sweeps, previous high, previous low, right? Boom. It goes past the previous highs, sweeps liquidity, fills all the sell orders, creates a momentum to the downside. Boom. Price starts getting dragged down. What happens? It fills all the buy orders, right? Because it goes past the previous low. Now it has momentum to go up. So that is how to tell when the market's about to turn around, right? So it fills liquidity, boom. It fills liquidity, boom. Liquidity sweeps. Nice. Market always wants liquidity, right? So we have things called imbalances, right? So imbalances, there's two different types: fair value gaps and inverse fair value gaps. Okay. So one's bearish, one's bullish. Okay. This one's bearish because we're on the way down. This one's bullish because we're on the way up. What are they and how do we identify and what do they mean? So imbalances essentially just mean price action moved too fast, right? What do I mean by price action? The candles, the price is dropping either too fast or the price is going up too fast. It's to the point where it's creating gaps in the market. Not all the orders are getting filled. So if we look here, we have a little gap, and that's why I created this little rectangle to be able to identify the gap. Without the rectangle, you guys might have not been able to identify the gap. So I'm gonna delete this. Like boom, what do you see? Price action drops. But the thing is, price didn't fill this or this, right? Because if it did, we would have no gap. But because price didn't fill that or that, we have this gap here. Boom, boom. So what do we do to identify it? We create a little box, right? So we create a little box to see how big the imbalance is or where it's at. So what happens? Price moves too fast, misses some orders. Price is greedy. The market is greedy and wants to fill all the liquidity because it wants more money. Goes back up into it because this is essentially a magnet, right? Just like liquidity sweeps, it's a magnet. Gap here, boom, right? Taps it. If it respects it, continues going down. If it disrespects it, we're going up. How do we know what a disrespect and a respect is? So easy, right? Price is, sorry, I had to do something. Luckily, this is a video, so it's fine. So we had we have price here, right? So if it's disrespected or disrespected, how do we know if it's respected or disrespected? Easy, right? Same thing we do with BOS, break of structure, right? So here we go. I'm gonna show you guys. As long as the body doesn't close past the imbalance, it's respected. So the body could do this, and it's still respected. The body could do this, and it's still respected. The body could do this, it's still respected. So I'm gonna ask you guys a question. You guys, I'll give you guys like 3 seconds to answer. This, would this signify as going up, or would this signify as going in here and then back down? Which one? 3 seconds. 2, 1. So if you guys said up, you're fucking wrong. Get the fuck out of here. You suck at this. I'm joking. Nah. So remember, if you said up, I said the body. Remember, the wick is not the body. We can't go up if it's not disrespected. The wick can go past it. The body cannot. If this happens, we're disrespecting it. We're gonna fucking go up. Okay? So, hope you guys got that right. If not, then now you know. Okay? So, now we move on, right? Right here. In this example, where would we go up? Where would we go up? Or where would we go down? 3 seconds. 2, 1. If you guys said down, you're fucking wrong. It's gonna go up because the body isn't past the fucking imbalance. We're gonna continue going up. We're gonna continue with the trend. Okay, so nice. If you got it right, congrats. If you got it wrong, it's okay. Just study it more. Okay. So nice. All right. We understand imbalances. Now we have these things called order blocks and breaker blocks. OB, BBS for short. OBS, BBS for multiple. Fucking just for one, it's OB and BB. You get the point. Okay. So what are order blocks and breaker blocks? They happened. They are what happens after liquidity sweep, and then they signify the next liquidity sweep. Okay. So we have a liquidity sweep here, previous lows, creates price, go up, goes down, price goes, sweeps previous highs, right? Boom, fills imbalances, what happens? Or fills orders, what happens? Brings price back down. Order blocks is bullish, breaker block is bearish. How do we identify the order block? Order block is the down before the up. So right here, we have this little down before the up, right? So technically speaking, because this is the down and before the up, this right here is as well a order block. And how do we know where it's going to go to on the order block, and how do we know if it disrespects or disrespects it? So that's something important with the order blocks and the breaker blocks. These are very volatile if disrespected. So right here, we have something called a gone box. We use this tool to identify discount prices between order block. At least personally, I use them to identify discount prices between order blocks, breaker blocks, imbalances, so on and yet. Like you're right, you want the discount price, you don't want the full fucking price. So this is what I use to identify it. So it's called a gone box, right? This is my settings on it. You can, pause the video, screenshot, whatever, and then you're good. Okay. So now you have the gone box, fancy all gone box. You can find it on the left. Gone box right there. Boom. Nice. You know where it's at. Boom. You can use this. I use this a lot. So we have the down before the up. What does it go to? It goes right to a discount price, continues going up. Or I did not mean to draw like this, but I apparently drew it so perfectly that it just dropped on the 618 and it kept going up. Amazing. Nice. So now speaking, because remember, I said the down before the up. Technically, this right here as well is an order block. What does it do? It goes under the 50 slightly and goes back up. Why? Because discount price, right? Discount price. Nice. So I use these for entries as well and exits as well. Just, I'll teach you guys how I trade in a bit, but just for now, just know these are very volatile as disrespected. So I'm going to show you guys what disrespected is on order block. So same thing, right? Closes past the order block, we're fucked. Or, like I said, it can wick all the way down here, but as long as it closes there, we're fine. As long as it closes inside of the order block, it's fine. It just cannot disrespect it. If it disrespects it, this is how volatile it is. If it disrespects it, it's either gonna, this candle, the one that closes there, the next one is gonna either absolutely shit itself, or I mean, you'll see. It's very volatile. Take your time, see the market, get used to the market, start seeing these things, and you'll understand why I say what I say, right? But be very cautious with order blocks and breaker blocks, right? The price is very volatile if disrespected, okay? Both ways. Okay, so breaker block, same thing, opposite, right? The up before the down, right? So here we go. We tap into the breaker block, boom, get rejected, go down. Nice. So now we know bullish, bearish. Nice. We go and move on to something called that's shit. I guess that's it. Okay, so let's see. And of course, all right, I understand this is a video. DM me if you have any questions. I'll go over anything. All right, so we have this right here. So, and these are, right, the shorts for everything. Equilibrium is essentially discount price. So we see here, we go into the equilibrium, right? Discount price, nice. We continue going up. So that's just all it is, okay? So reversals, liquidity sweeps. How do we know what a liquidity sweep is? What is a liquidity sweep? It is a sign of a reversal, right? What does that mean? The trend, if it's going up, hits a liquidity sweep, it's going to fucking go down, right? It's going to reverse on us. Nice. Confirmations. Essentially, you're looking for a confirmation on your bias, right? So seeing what you think the market is doing. You look for a break structure, inverse value gaps, or fair value gaps to confirm your idea. Or you have continuations. You have fair value gaps, inverse fair value gaps, order blocks, breaker blocks, equilibrium. You're looking for continuation, signs that the trend or whatever your trade idea or whatever you think the market is doing, you're looking for signs of continuations, right? So you're looking for these things to go forward your bias. As long as all of these things are getting respected, then your bias is good, right? But the moment your confirmations or your continuations is starting to seem kind of sketchy, that's when you start paying a lot of attention, because if they start seeming sketchy, chances are you'll find the change of trend, right? You'll find a disrespect happens somewhere, somehow. Next thing you know, it's not going no longer, right? Let's say you catch this right here. You're expecting it to go higher, but then you start seeing something sketchy. Boom, break structure here. You're like, oh, okay, it's fine. It went back up. Boom, right? Now that's worrisome because we created a previous height, right? So we went from low, higher, higher, or lower, high, higher, low, higher, high, higher, low, higher, high, then lower, low, lower, high. Fuck, even lower, low, even lower, high. We changed. Oh no. If you got in down here and you're chasing it up all the way up to here, doing some, I don't know, fucking something here, you caught it down here. Your entry is here, right? Because you're trying to make money or whatever. You bought in cheap, tried selling high. You're seeing it drop, right? So you want to make sure you know this is happening, so you don't lose too much profits or your actual money if you fucked up and entered over here for some reason. You know, don't buy the fucking top, dude. Just because everything seems, oh my gosh, it's sending, it's going good, price is gonna come down. What goes up has to come down. Be fucking patient, right? And if you can't be patient with the market, it'll teach you how to be patient. If not, you'll quit. Simple as it is. Nice. We know lessons are gonna be learned, and it's fine, right? As long as we grow, growing is the number one thing in trading. Also, trading isn't just fucking making money, dude. Trading is trading is a self-improvement journey. You get to know yourself more. You get to realize, certain things about yourself that you didn't know before, because you're going to have so much time and everything is going to be on you. Not a single thing is not on you. You can't sit there and say some bullshit that, fuck, I lost money because someone else. No, you lost money because you decided to fuck around and do the wrong thing, because you were trying to either force a trade or you were trying to force a bias. It's like saying, fuck, the price is dropping, but I think it's going to go up. And you fucking dump in 10K in there. Motherfucker, you know the price is dropping down. Why the fuck would you dump money in there? Find a bottom. Find something that's going to show a reaction to the upside. And then once it hits your target, nice. Why? Because you found a bottom. What's going to happen? Chances are, even if you don't find the exact bottom, because of your buys, because of your targets, it's going to bounce up. So no matter what, you're guaranteed to make at least some money. Worst case scenario, you set your stop loss to a point where you don't lose much money. Stop losses just means the most amount of money you're willing to risk. So you can move your stop loss into profit, meaning you don't lose anything, right? That is that simple. Everything else is literally the same exact thing. Trading is a self-improvement journey, and it's a one-on-one. It's you against yourself, no one else. You have no competition. You don't. And if you think you do, congrats. Everyone else, 99% of your competition has already fucking quit. If matter of fact, they haven't even given this shit a shot, and you're over here stressing about yourself. Chill. It's you against yourself. Some people can click after 2 weeks. Some people click after 2 months. Some people click after 2 years, and so on and so on. And if you're not willing to stick through this, it's fine. Quit today so you don't waste your time and you don't waste my time. Okay? So we have different sessions. Sydney, I'm Eastern time, okay? I'm East Coast. I live in North Carolina, so I have different time zones than some of you guys. If you guys have the same time zone, nice. Fuck, nice, okay? So there's things called sessions. Different markets open at different times, right? So for Sydney, as an Australia session, they open at 5 p.m. to 2 a.m. Eastern time. Asian session opens 7 p.m. to 4 a.m. Eastern time. London session opens 3 a.m. to 12 p.m. Eastern time. New York opens 8 a.m. to 5 p.m. Eastern time. Essentially, as a trader, you don't have to clock in to a fucking job, but you do have to figure out what session you want to trade, right? So for me, I always wanted to trade New York, right? 8 a.m. to 5 p.m., but I was too busy at work. What did I have to do? I had to stay up for London for quite a bit of time until I was good enough to quit my job and be able to trade the session I wanted to trade, okay? So I'm going to go based off volatility. Volatility, Australian session and Asian session aren't the most volatile. They're somewhat steady. You're good. If you want nice, peaceful trades, there you go. London, somewhat volatile, right? It's one of the most volatiles. New York, the highest volatile. So that right there is New York is considered the hardest market to trade. So if you're new and you learn to trade on New York, this is the way I'm thinking, right? This is the way I think. So the way I think is if I can learn on the hardest things, everything else is going to be a breeze, right? Boom. There you go. That's the way I think. Okay. So I traded London because I wanted to trade New York. So there's a sweet spot between London and New York, right? Between 9 to 10:30, maybe 11 max. That is the perfect time to trade because it's a mix between London and New York, as in the two most volatile fucking markets, and they're merging sessions right there, and that's a sweet spot. That is the most volatility you'll get, as in this. I wouldn't say smoothest, but it would be a really good time to trade. You'll see why if you pay attention. So we have previous session consolidation. Let's say Australia consolidates, all right, and I'll show you guys what this means later on. And then Asia session manipulates, London session reverses. Okay, then we have manipulation, right? So let's say London manipulates, New York reverses. Okay, so let's say New York manipulates, right? And then we have Australia reverse, and then Asia continuation for the next session. Okay, so that's how that works. Now here it is. So essentially, manipulation is just a fucking yank. Okay, and you'll be able to see it. You'll fucking clearly see it. So previous session, let me drag this so I can give you guys examples. So previous session, let's say Australia consolidates, right? We have Asian manipulates and then reversal. Boom, right? Reversal would be London, right? So then we have let's say Asian session manipulation and then London reversal. Okay, then let's say Asian session fucking manipulation reversal for London, and then New York continues it. Okay, that's how manipulations, or so that's how a market moves. The session works, and that's how you can kind of tell, get a bias as well, see what's going to probably happen. That is something to keep an eye on, right? Sometimes these are really easy to read, sometimes they're really hard to read. And that's why you don't rely on this on its own. That's why you learned all of this shit, right? Okay, so now let's learn about stop losses and take profits. Take profits is where you want to take profits, right? Pretty self-explanatory. You want to make money, so you have to find spots where you want to take your money out. Your targets, okay? Stop losses. You stop losses is really just the most amount of money you're willing to risk, right? Because this is a trading is always you're risking money. No matter what, you're always risking money, right? If your idea is wrong, if your trading idea is wrong, you're risking money. You're gonna lose money, right? Because your trade idea is wrong. But if it was right, you're gonna make money, right? So that's why this is here for risk management. For and it like maximum amount of money you're willing to lose per trade. Okay. So here's how I trade. Okay. So we look for key levels, high liquidity, previous highs, 1 hour time frames, 4 hour time frames. Oh shoot, here's something I probably should have gone over. So the candles, they work with time frames. So if I look at the 1 minute time frame on the candles, right? The candles, where are they even at? Here we are. So each candle would be 1 minute, 1 minute, 1 minute, 3 minutes there. If I go to the 3 minute time frame, this whole thing would be one candle. It would look like this. Boom, boom, and then bam, bam. Literally just gets shoved into one candle. So the higher the time frame, the more candles in there, and the higher the time frame, the more strength and the more it means. So if you have an imbalance on a daily, it's a bigger magnet than if a fucking imbalance on a 1 minute. So if there was an imbalance, let's say an example would be here. So let's say there's an imbalance on a daily here. Boom. I know it's one candle, but let's pretend, right? So imbalance here, imbalance here. Price is here. Because there's an imbalance on a daily, which is a higher time frame, which has more respect, which has more power in a way. It's more of a magnet. Price is gonna, instead of going to the 1 minute, it's gonna go to the 5 minute or fucking 1 hour or daily. That makes sense. The higher time frame, the more respect it has. So you should get your bias on the higher time frames and see price action move on the lower time frames. So higher time frames to get your bias, lower time frames to find an entry or take a trade. You could take longer trades based on higher time frames. Chances are it's going to take longer, right? Because you're in a higher time frame, it's going to take longer to react. But the smaller time frames are probably going to be quick trades, nice and good trades, as long as your bias is right, as long as everything, And essentially, that is what I mean by, where is this even at? Goodness. By key levels, right? So high time frames, order blocks, breaker blocks, liquidity sweeps, fucking whatever, Anything that's on a higher time frame, right? Preferably I do 1 hour to 4 hour, sometimes daily, depends. And then we have the time I trade, 9:50 to 10:30, max maybe 11, right? Nice. That's, like I said, the sweet spot. Sometimes I start literally spot on at 8 or 9:30 or 9. It just depends on how the market is moving. You can't expect the market to be perfect. It's never going to be perfect. You have to work with what you have, and as long as you're able to understand that, you'll do great. Okay, so there's plenty of times to trade. Okay, so then we have my strategy. So we wait for a price to hit a key level, right? Key level. Then we scale to the 5 minute time frame. Wait for a confirmation. BOS, IFEG, equilibrium. Wait for the 5 minute continuation. FEG, OB, BB, EQ. Then we wait for the 1 minute confirmation. BOS, IFEG, FEG, and then we enter. Stop loss is where our idea is wrong. So an example would be if it creates a lower low on a higher time frame and we're looking at an uptrend on the 5 minute, that would signify it's fucking shitting itself, right? It's going to continue going down because we're on it's, you know what I'm saying? Like the part where your trade is completely wrong is where, and I'm not saying like we're taking a trade, I think I had it. We're taking a trade here, right? Now, I'm not saying your stop loss is going to be all the way fuck up here because your trade idea is all wrong. No. It's at a key spot where your trade is wrong. So what would it mean for this trade to be wrong if it created a higher high, right? That would mean it's going to create a higher low, so on and so on. That makes sense? Something simple like that, right? Wouldn't just be that, like, but you would make sure your stop loss is secure, right? And then through time, you would find supports. Let's say this happens, boom, boom, Boom. You would move your stop loss, right? Lower into profit because your entry's still here, and you would keep dragging it on supports as an area. As if it breaks through, chances are it's gonna reverse, right? So you're gonna would keep moving it to supports until you either hit TP or your trade idea gets invalidated before it hits TP, and you know you get tapped out. But the thing is, with that, you're guaranteed money every time. That's starting off. Okay, starting off. I do not recommend that later on. If you have the ability to literally just take a loss, then take it, right? Take a loss, understand why you took the loss, and move on. But if you don't have much capital, this is the safest way to protect your capital. If you have capital, nice, as in money. If you have capital, capital means money. So if you have money, nice. You get to just sit there and watch it hit your TP, so you're not stressing about moving and missing out. Because the thing is, with this, right? Yes, it's gonna save your capital. The thing is, sometimes it does this, but then it hits your TP. You see what I'm saying? So you get tapped out, and then it miss out on that money. So that's why it sucks in a way, but it's protecting your capital. So if you don't have capital at first, nice, right? But if you're able to take the loss, right? I'm not saying take every fucking loss. If your trade idea is ass, like if you suck at this, don't be sitting there fucking taking like 5 losses back to back, dude. Fucking use your stop loss. Damn. Don't be stupid. Don't be fucking dumb. Use your brain, right? So that's literally how I trade, right? So stop loss where trade idea is wrong. And then take profit is at either key levels. So previous highs, previous lows, and then whatever, right? So there's right here, this is shorting. We're betting against the market. We're betting that price is going to drop. Longing is literally the opposite. We're betting that price is going to continue going higher, right? So that's the fuck. That is the helly. That is the two different types of ways you can trade. Boom. Short, long, right? Nice. You understand both. One is going down, one is going up. Okay, so then we have settings for your chart. I'd recommend changing them. I just have fucking black and white basic ass colors. The reason I would recommend changing them is because green and red are one of the most psychological harming, or they make your emotions come out. And trading is a very psychological. It's heavy on a psychological aspect, right? So if you have a weak mind, trading is going to be heavy on you. To help you do that is this. I don't even have a weak mind. I just fucking it's easier for me to just not even like give a fuck. Like I generally don't give a fuck. Plus the colors look better, and plus I like to keep my room a little dim, so these colors just genuinely help. If you like bright ass green and red, fucking by all means. But personally, too bright for me. I don't really care for it. But like I said, if you have a weak mind, I would guarantee that I'm not guaranteed. I'd fucking change the colors. Like I said, personally, I honestly traded with fucking green and red for a long time. Matter of fact, some of my fucking exchanges still have green and red, but it's just because like it doesn't really fucking matter. It's just if you have a weak mind, change them. If you don't, it shouldn't really matter. But starting off, might as well, right? Just to help you understand your emotions easier, rather than you going green and red and seeing a big ass red and seeing red in your whole fucking wallet, as in your bag, just getting swallowed by the market. You you put $500, you worked your ass off for $500. Next thing you know, that shit's down to like $50 left. Yeah, that's gonna affect you, right? It's gonna affect your emotions, especially with a big red fucking candle. It's gonna want you to fucking close your trade. But the thing is, well, that would be if you're full porting, right? Fucking stupid thing to full port. Don't full port unless you know what you're doing. And even then, it's kind of still stupid. But if your fucking idea is right, and it's gonna pay off, right? It's a high risk, high reward. Fucking, it's on you, right? It's up to you. But point is, seeing your money go up and down fast, red and green, triggers emotions. Just wouldn't recommend. So other than that, that's literally it, guys. So hope you guys understood anything. If you guys don't understand anything, fucking DM me. I'll go over it again. All right. Anyways, study the shit. Fucking, let's see a million by however the fuck long you want to see that. But I'm seeing it by the end of this year.